Most people think that if they have $10,000 sitting in their banking app, there's a real vault somewhere holding that cash. Or maybe you're thinking, well, don't banks just take the money that other people save and lend it out to borrowers? I used to think the exact same thing, but that vault doesn't exist, and that is not how loans work at all. So let me show you how banks secretly create money out of nothing, why they don't actually need your savings to do it, and how that exact same money vanishes into thin air. When you walk into a bank to borrow $10,000, they aren't touching anyone's savings account. It really is that simple. They literally just type the digits into your account. The banker taps a few keys on a keyboard and boom, $10,000 is born out of nowhere. You heard me right. It's just a click of a button. Now, if it's really that easy to create money from thin air, you're probably asking yourself, why do banks still want my savings then? Why do they even care about my deposits? Well, here is where the story gets really interesting. Picture this. You just got approved for a $10,000 loan. The bank typed the money into your account. You go spend it. Maybe you pay your landlord. Maybe you send it to someone at a completely different bank across town. The moment that money moves to another bank, the original bank has a problem. See, banks do not actually settle transactions using the digital money they create. They settle using something called central bank reserves. Think of reserves as the real money that only banks can hold and use between themselves. It lives at the central bank. Ordinary people cannot access it. You will never see it in your account. It exists in a completely separate layer of the financial system that most people do not even know is there. And when your $10,000 moves from Bank A to Bank B, Bank A has to hand over real reserves to Bank B to cover that transfer. Not digital money, not the stuff they typed into your account. Actual reserves, the real thing. So here's the question. Where does Bank A get those reserves from? That is exactly where your savings come in. When you deposit money into a bank, you are not giving them raw material for loans. You are giving them cheap reserves. Reserves they can use to settle transactions when their borrowers spend the money that was created. Every time someone takes a loan from Bank A and sends that money somewhere else, Bank A needs reserves to back that up. And the more deposits Bank A holds, the more reserves they have available without having to go borrow them from other banks at expensive overnight rates. Now, here's the profit part. The bank pays you maybe 2% or 3% interest on your savings. Then they turn around and create loans charging 7%, 8%, 10%, sometimes significantly more. The difference between what they pay you and what they charge borrowers, that spread, is pure profit captured every single day on billions of dollars simultaneously. So no, the bank is not lending your savings to the person who just got a mortgage. That is not what is happening. But they absolutely want your deposits sitting there because your deposits give them a cheap, reliable, stable pool of reserves to keep the whole machine running without having to borrow from competitors at rates that would eat into their margins. Your savings are not the raw material for loans. Your savings are the oil that keeps the engine from seizing up, and the bank profits enormously from that difference every single day. Now let me show you exactly how a loan actually gets created. Every bank has what is called a balance sheet, two sides. Assets on one side, that is everything the bank owns or is owed. Liabilities on the other side, that is everything the bank owes to someone else. Now, you walk into a bank, you need $10,000, you sit down, you sign a loan agreement. That signature, that contract, is a legally binding promise that you will pay the bank back with interest over a set period of time. And the moment you sign it, something extraordinary happens on that balance sheet. Your signed contract goes on the asset side, because from the bank's perspective, your promise to repay is something of real value, something they now legally own. It is an asset sitting on their books. At that exact same moment, not a second later, not after any transfer happens, simultaneously, the bank writes $10,000 into your account. That $10,000 sitting in your account is recorded as a liability for the bank because they now owe you that money whenever you want to access it. Both sides of the balance sheet expanded at the exact same time. Asset side went up by $10,000, liability side went up by $10,000. The balance sheet still balances. Everything looks clean. Everything looks legal. Everything looks completely normal to anyone reading the numbers. But here's what actually happened. No money moved from anywhere. No savings account was touched. No vault was opened. No existing dollar changed hands. No transfer happened between any two accounts. The bank simply wrote a number on one side of a ledger and a matching number on the other side, and in doing so, created $10,000 that did not exist 5 minutes earlier. Your promise to pay created the money. The bank just processed the paperwork. Now multiply that by every single loan being signed at every single bank in every single country on earth simultaneously. Every mortgage, every car loan, every business credit line, every student loan, every personal loan, all of them creating new money at the exact moment the contract gets signed. That is how 97% of all the money in the entire economy came into existence. Not from a government printing press, not from a vault somewhere, from loan contracts, signed by ordinary people, every single day. And if that makes you feel a little uneasy, good, because what comes next is the part most people find genuinely hard to believe even after they have seen the evidence. So now you have your $10,000, you spend it, life goes on, and every month you make your loan repayment like a responsible borrower. Most people think that repayment goes into some vault, or gets lent out to the next borrower in line, or sits somewhere accumulating interest for the bank. It feels like the money must go somewhere. Money does not just disappear, right? Wrong. Let me break down what is actually inside your monthly loan payment, because every single payment you make has two completely different things hiding inside it, and most people never separate them. The first part is interest. That is the bank's fee for creating the money in the first place. It is the rent you pay for the privilege of having those numbers exist in your account. That interest is real profit. It goes to the bank permanently. It pays salaries, bonuses, shareholder dividends, executive compensation, branch costs, everything. The interest is the bank's reward for typing those numbers into existence. It stays forever. The second part is principal, and this is the part that will genuinely make you stop and reread the sentence. When you pay back the principal, the actual $10,000 you borrowed, that money does not go into a vault. It does not get lent to someone else. It does not sit in a reserve account earning anything. It does not go anywhere. It gets deleted. The same computer ledger that created the $10,000 when you signed the loan contract destroys it when you pay the principal back. The asset side of the balance sheet goes down as your debt decreases. The liability side goes down as the bank's obligation to you shrinks. Both sides contract equally. The balance sheet balances again, and the $10,000 that existed for the entire life of your loan, that was real enough to pay your landlord, buy groceries, cover your bills, simply stops existing. Economists actually track this. When loan repayments outpace new loan creation, the total money supply in the economy shrinks. Real people feel that. Spending slows. Businesses see less revenue. Jobs become harder to find. All because the digital money that was powering those transactions got deleted as loans got paid back faster than new ones were created. The money was born the moment you signed. It died the moment you finished paying the principal back. And the only permanent survivor, the only thing that outlasted the entire transaction, was the interest you paid along the way. The interest was the product the whole time. The loan was just the delivery mechanism. Now here's the part of this story that stops being about accounting and starts being about your actual life. Your rent, your grocery bill, the house you have been trying to buy that somehow keeps getting more expensive no matter how disciplined you are. Because banks can create money with a keystroke, where they choose to point that money matters enormously. And the honest truth is, they do not always point it in directions that help ordinary people build wealth. Think about someone saving for a house. Let us call him Tom. He has been saving seriously for 3 years, putting away every spare dollar, watching his savings account grow, getting closer every month to the deposit he needs. But while Tom is saving, banks are creating new money and pumping enormous amounts of it into the property market. More mortgages, more real estate loans, more newly created digital money chasing the same number of houses that existed before that money was created. What happens to house prices when more money chases the same number of houses? They go up consistently, reliably, almost without exception. So Tom saves $30,000 over 3 years, but the house he was saving for went up $45,000 in the same period. Not because it improved, not because the street got better, because bank-created money inflated the price faster than his earned income could keep up with. He is further from the house at the end of 3 years of saving than he was at the beginning. Not because he did anything wrong, because the money being created around him is flowing into assets faster than his labor can match. And that same dynamic, bank-created money inflating asset prices faster than wages can catch up, is one of the core reasons why the gap between people who own assets and people who are still trying to acquire them keeps widening every single year. Small businesses that create real jobs and real products in real communities get a fraction of the lending that flows into property and financial assets. Because lending against property is simple, safe, and profitable for the bank, lending to a small business starting out is complicated, risky, and requires actual human judgment. So the money flows where the bank profits most, not necessarily where communities need it most. The result is an economy where asset prices feel unstoppable, real wages feel stuck, and ordinary people work harder every year just to afford a life that their parents could afford on one income a generation ago. That is not bad luck. That is the predictable outcome of a system where the people who control money creation also control where that money flows first. Now look, none of this means banks are evil or that the whole system needs to be burned down. Money creation itself is not the enemy. Every functioning economy needs a mechanism for creating credit to fund growth, business investment, mortgages, and innovation. Without it, the modern economy does not work. But understanding how it actually works, really understanding it, not the the simplified story about vaults and deposits changes how you see the world around you completely. It explains why holding only cash feels like losing ground every year. It explains why people who own assets seem to get richer automatically, while people who only earn wages feel like they are running in place. It explains why the financial system sometimes feels designed for someone else, while you are just living inside it trying to keep up. Because the people who truly understand money creation do not just react to the financial system, they position themselves ahead of it. They hold assets that rise when new money floods the market. They borrow at low rates against things that appreciate when more money gets created. They think like the institution instead of like the depositor. That shift from depositor mindset to asset owner mindset is honestly one of the most valuable things you can walk away with from this video. So if you have a friend right now who still believes banks just lend out vault cash, do them a favor. Send them this video, because that one misunderstanding about how money actually works costs people more than almost any other financial belief they carry through life. And drop your thoughts in the comments. I genuinely want to know, did you know any of this before watching? Or did something in this video change how you see the whole system?